Hi everyone, welcome to Anu's classroom. In this video, we'll be discussing on the few important question and answers from Unit 6 of MMPC 14, that is Financial Management. This is a paper that belongs to SEM 2 of your Semester 2 of IGNOU's MBA syllabus according to the new syllabus. Let's get started. The first question that we come across in this unit is examine the different types of capital projects and explain why they are often approached differently. Well, a capital project is a long term project that is used to build or improve or maintain or develop a capital asset. This type of project involves a significant as well as consistent flow of investment. A capital project can be a large scale one or something that is needing constant management and resources for completion. The company cost of capital is the rate of return that is expected by the existing capital providers, and the project cost of capital is the rate of return that is expected by the capital providers for a new project that the company proposes to undertake. So it will depend upon the business risk and the debt capacity of this particular new project. The company cost of capital, which is also known as the weighted average cost of capital, is the right discount rate for an investment, which is a carbon copy of this existing firm. Okay, so the different types of capital projects include the new projects or new markets, expansion of existing products or market, the replacement project necessary to continue normal operations, the replacement project necessary to reduce business costs, and the like. So, as you can see, depending upon the different types of projects, the way in which we have to account for the cost of this capital, okay, and thereby assess whatever is the return that we need to maintain our profitability or increase our profitability, or however our growth, or however we can meet our business goals and objectives, they differ, right? The way in which new projects or entering into a new market has to be looked upon, or with or um, um, difference to a replacement project, okay, they are both different. When we are talking about a replacement project, then we'll have to think about the replacement value and liquidity things, right? Maybe we'll be selling off the old ones and we might be acquiring the new ones, okay, or we might be replace, yeah, so in effect we are trying to replace it. Whereas if it is new, then we might maybe lease, maybe hire, or maybe even buy new assets in order to make that project up and running, right? So in all these different things, the cost of capital considerations, they change, and that is why they are all approached differently. In case you like our videos, consider subscribing, share our content with your friends as well. It will really help our community to grow. I really want this channel to be a place where we can all come and discuss and get better at being business administrators of the future. Now, what is the next question is, what is payback period? Why does this method enjoy a good deal of popularity? What are its limitations? So, what is payback period? The term payback period, it refers to the amount of time it takes to recover the cost of an investment. Simply put, you can think of it as the length of time an investment reaches a break-even point. It is the length of time an investment will take to reach its break-even point. It is a method which refers to the amount of time it will take for the complete amount that is invested in the project or into that particular firm or enterprise be recovered through the net cash flow that is calculated after tax. Calculating this payback technique is actually very simple and straightforward. So, therefore, it enjoys a great deal of popularity. But what happens is that this payback period method, it disregards the timing as well as amount of all the cash inflows. The cash flows following the payback period are also not considered. So, as a result, this method is actually quite ineffective for both absolute as well as comparative evaluation. What is internal rate of return? Are the internal rate and payback related? So, the internal rate of return, or IRR in short, it is a metric that we use in financial analysis to estimate the profitability of potential investments. It is the internal rate of return is the annual rate of growth that an investment is expected to generate. It is ideal for analyzing the capital budgeting process projects to understand and compare potential rates of annual return over time. The internal rate of return rule is a guideline you can for evaluating whether a project or investment is worth pursuing or not. And whereas the payback period, it refers to the amount of time it takes to recover the cost of an investment, or how long it will take for this investor to hit break even. So when we think about payback period, we are what you can say indirectly thinking about break even analysis. Whereas the internal rate of return is our way of thinking whether um, investing into this particular project or this particular idea is worth it or not, whether it will give me the returns or not, is it worth pursuing. Next question, what are the essential limiting factors in the reliability of capital budgeting measurement techniques, including discounted cash flow? So the main limiting factors are that it has long term implications. A wrong decision in the early stage of the project or the business can affect the long term survival of the company. Like, for example, you might have heard of Anchor, right? Anchor was a very famous company in India. And their electrical equipments, especially the wire and all, still very popular. But right now, there is Anchor as such, which used to be an Indian company, is right now owned by Panasonic. So there are actually many factors which led to this. Okay, but one of the important, what you can say, cornerstone or turning stone kind of thing happened when Anchor, at the time of this LPG, the reforms of 1992, when liberalization, privatization, globalization happened. They feared that with the entrance of other competitors into the market, into the electrical equipment business, they might lose their market share. Rightly so, right? Now with the globalization, India is opening its borders to different companies. They are all going to come set up their plants or their outlets, and market share would definitely, now we'll have to compete for the market share, right? So what happened is that they tried to they thought of what you can say, diversify their operations. So they're well established in the electrical equipments market. Now they thought, after all, a lot of very bright minds of the country, they sat together, they found out, they did a lot of analysis, financial analysis and everything, and they found out that better maybe we can diversify into the consumer market. And into the consumer market, first we'll launch a product called fruit beer. Okay, so now what happened is that they did their capital budgeting, and they found out that they will invest around 350 crores into making a new plant and making coming out with this fruit beer. But then once the product launched into the market, into the public markets, what happened is that the our population, the Indian community, the Indian population, they outright rejected the product, and it was a big flop. They lost the entire investment of 350 crores, right? So what happened is that they failed to understand how we as Indian, in the culture, we how do we think of beer? Beer for us is, whether it have alcohol content or not, whether it's created from hops or fruits, doesn't matter. Why do we use beer? Beer is a substance for intoxication, right? So if you are drinking that product and you're not getting intoxicated, and especially with the price point, I think it was priced almost in the same price range as intoxicating beers. Okay, so you're paying this much of money and you're not even getting a small kick out of it. The Indian community just kicks the product out of the market itself. Okay, so that is one of the examples how a wrong decision in the early stages of your business can affect the long-term survival of the company. Though they were able to sustain that loss of 350 crores, then one thing did lead to the other, and then finally they ended up having to sell their company off to Panasonic. Now, the inadequate investment makes it difficult for a company to increase its budget as well as capital. Capital budgeting involves large number of funds, so that decisions have to be taken carefully. Decisions in capital budgeting are not modifiable, as it is hard to locate the market for capital goods. Estimation can be in respect of cash outflow and the revenues or savings and costs that are attached with the project. So these are a few limiting factors. Now, next question is, discuss about the cost of capital as a device for establishing a cutoff point for capital investment proposals. So, in this question, we need to know exactly what a cutoff point is for capital investment proposals. So, a cutoff point is a subjective point at which an investor would decide whether or not a security is worth buying. Cutoff points, they vary widely among investors and can be dependent upon the investor's risk aversion level as well as their desired rate of return. Like, for example, if both me and you have both 100 rupees and we are thinking of investing it into the stock market, I might set up a different stop loss than you, right? I might set up a different sell point than you. So that is the cutoff point, the target point, or the sell, what you can say, the stop loss point. Those points, they are called the cutoff points. When the money or the value crosses these points, either it crosses above target, we sell the security, or if it crosses below the stop loss, then also we sell the security, right? So these points, they are called cutoff points, and they vary depending upon our risk aversion level or desired rate of return. I might be highly risk averse, so even with a like 1% decrease in price, I might decide to sell off. But you might be very high, you might have a very high aversion. Sorry, you might have a very low aversion to risk, so your cutoff stop loss point might be at 20% or so, like that. I hope you understood the cutoff point concept, right? The cost of capital is the minimum rate of return or profit the company must earn before generating the value, right? Now, if the return on an investment, if it is greater than the cost of capital, then that investment will end up being a net benefit to the company's balance sheet, right? So, at the same time, conversely, if an investment whose return is equal to or lower than the cost of capital, then it indicates that the money is not being spent wisely, right? So this is how we use the cost of capital as a device for establishing these cutoff points. Okay, so that is it. Those were the few important questions that I came across in Unit 6 of MMPC 14. Thank you and see you in the next video. If you like our content, once again, consider subscribing. It will help us grow as a community and help our contents reach more and more people, and thereby benefiting them as well. So if you like our content, do contribute by hitting the subscribe button as well as the share button. Thank you. See you in the next video. Bye bye.